please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. A new financial year has begun, and when it comes to tax planning, they say the earlier the better. Now, the Central Board of Direct Taxes has also released this year's income tax return forms, and they involve some changes here and there. So this week on Money, 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 we bring you up to speed with all the new tax changes that come into effect in FY19 and also take you through the new ITR form so you know exactly which one you need to file. My guest on the show is Mayur Shah, partner at EY, and of course he's a personal taxation expert. Always helps us when we're trying to understand these complicated tax issues. Mayur, thanks so much for taking out the time and joining in. Let's actually first start with the ITR forms, because that's going to be the next event for the taxpayer, right? When you have to file your returns, make sure you're in time for July 31. So I'm sure you would have gone through, all the forms. Any major changes or minor tweaks only this time?
Yeah. So thank you, Surabhi. A couple of points which we need to know is that first, who is required to file the return, and then we should go on to what are the changes and what it means for all of them. So the person who has taxable income without claiming any deductions under Chapter 6A, which deals with payment, medical premium, insurance, 8IC and all other deductions. Without that, if a person has a income which is above threshold limit, that is 2.5 lakh, in that situation, all of them have to file their return. The second category of persons who do not have that kind of income, but still they have any foreign assets, then they are also required to file the return. Now, the third category is that where a person has any income which is resulting into a loss. So, actually there is no income to be offered, but loss which needs to be carried forward for subsequent years. Even they are required to file the return. And the person who wants to claim refund of taxes which has been paid and they don't have any additional tax liability, in that case also return is required to be filed. Now, given that there are various requirements of return filing, it is essential that which form to be used for filing the return. Now, if we look at ITR 1, which is very simple return, where you don't have any complicated income, you have just salary.
The Sahaj form, is it called?
Sahaj form, absolutely right. So it is so Sahaj, but it is only for the income which are from different sources without. So it should not cover any foreign income, foreign assets. You are not claiming
no capital gains in this category.
No capital gains, no non-resident. So the return can be filed for salary income if you have one house property and some interest and other income. For them, it is best suitable option, provided their overall income does not exceed 50 lakhs.
In 1 year.
In 1 year.
You mentioned NRIs, and that is one of the changes that's come in with the new forms, right? Because I think now onwards, this year onwards, NRIs can't use ITR 1 Sahaj.
Yeah, so basically, they have to provide certain other additional information. They are claiming any treaty benefits or things like that. So it becomes much easier to use other forms because requisite information can be furnished there. And because, the income tax office is going more on digital. So because of filing those returns, claiming treaty exemption, it becomes very easy for them to process rather than calling for an audit or a scrutiny of those returns. So it becomes much easier.
Okay. Right. So that is as far as NRIs are concerned, but within ITR 1, in the new form, are there any changes we should keep in mind?
Yeah. So the changes which are there, that if anybody is filing return beyond the due date, and there is a mandatory fees or penalties which needs to be paid. So the person who is drawing income less than 5 lakh, the penalty which one person has to pay is 1,000 rupees.
Okay.
Whereas a person who is having income above 5 lakh but filing return after the due date,
which is 31st July.
Which is 31st July. But before 31st of December, then penalty is 5,000 rupees.
Okay.
But the person who is filing after December but before 31st March, then they have to pay penalty of 10,000 rupees. So they have provided a field for that to be filled in the return of income. And suo moto, those penalties are required to be paid. The other change is that, say if anybody has let out any property and to an individual, where individuals were not required to deduct any TDS so far. But from June onwards, this has been enacted that from June 17 onwards, anybody is paying rent above 50,000, at least they have to withhold tax and deposit into government treasury. So the person who receives that income will also have to claim credit for those taxes paid. So they have provided even fields for them, so that they can claim appropriate credit for the taxes which has been deducted by the tenant.
Yeah. So this is part of ITR 1 itself.
This is part of ITR 1, and it has been carried out all across all the ITRs.
Okay.
So all these changes are common in all the ITR forms.
Now, again, to clarify this one point, that apparently now salaried individuals who are using ITR 1, earning less than 50 lakhs, they are required to make certain additional disclosures, is it, with respect to perquisites, salary breakup, etc.?
Sure. So earlier in ITR 1, there was no requirement. You have to just fill up what is the gross total salary which is taxable. That needs to be reported. Now we have to provide a breakup in terms of salaries, allowances which are not claimed exempt, and taxable perquisites. Also, if any terminal payments or any other payments are made, are to be disclosed separately.
Okay.
This is just for easy processing. So if anybody is claiming gratuity or any other exemptions, so they don't have to scrutinize those returns, but they can be processed through the system itself.
Okay.
So this is just to ensure that appropriate processing of return happens digitally rather than manually.
Okay.
And that seems to be the fundamentals of revision of these forms.
Okay. I want to now come to, income taxpayers in the business category, small businesses. A lot of them were using, I think it was ITR 4. Now there is a GST link. I think there are certain disclosures with respect to GST that have to be made. So explain that.
Sure. So, there are two forms for a person who is having business income needs to be considered. One is ITR 3 and another one is ITR 4. Now, ITR 3 is for the persons who are not getting tax under presumptive taxation or who does not want to offer presumptive taxation. That's where they have to provide details in terms of what are the taxes which they have collected and they have deposited into the government treasury, such as sales tax, VAT, or GST, whether central GST, state GST, and other related payments. So those are required to be disclosed separately in Form 3, where the person is getting taxed not on a presumptive basis, but on a real net income basis. Whereas ITR 4 relates to presumptive taxation.
Okay, where you're assuming that this is going to be your income.
Correct. And in that situation, you don't have to provide all this information. So Sahaj for 4 on presumptive taxation remains the same what was last year.
Okay.
The information which is requested now in ITR 3, which was earlier not there. But earlier they used to correct sales tax, VAT, and other related taxes. So now, because in this year you have both, for up till July you have sales tax, VAT, and everything, and post it only GST. So therefore all information they are collecting.
Okay.
So as such there is no change in the return form.
And senior citizens, apparently, I think senior citizens can now file physical returns.
Yes, senior citizen can file physical returns instead of electronic. But there are very small things which are to be done. So it is not that it's a big deal in that.
Okay.
Only thing is the person who does not have salary or person does not have a business income at all, but having salary more than 50 lakhs or total income more than 50 lakhs, they have to fill up Form 2.
Form 2, yeah.
Yeah. And for them, it is quite comprehensive. Most of the details are required. If you recollect that last year, everybody who is whose income is above 50 lakhs, they had to disclose all the assets which they are held.
Yes, that assets and liabilities schedule, we have to prepare a balance sheet of yourself.
Kind of a balance sheet, yes. So they have to continue with that even in this year as well. Those disclosures are still required to be done.
This is above 50 lakhs.
This is above 50 lakhs.
Okay.
And therefore there is a different form ITR 2. As opposed to ITR 1.
ITR 1. Got it. Right. So there you go. Now you know all the income tax return forms. It's absolutely clear. You can go ahead and pick the right one for you and file in time, which is 31st of July, if you want to avoid the penalties. We take a break on that note, and when we come back, we get started with FY19. It's a brand new financial year. So what is the taxation system like? The slabs, the couple of the important changes. We get down to talking taxes with Mayur Shah when we come back.
Gabon is on the fast track to becoming the most favorable investment destination in Africa. The NCOC Special Economic Zone has opened its doors to international investors, providing major tax benefits like 0% tax on dividends, 0% tax on income for the first 10 years, 100% exemptions on corporate and capital gains tax, 100% foreign ownership and more. Come, invest in the manufacturing sector in Gabon.
Wow, cheese, crust, toppings, सब improve हो गया यार.
तेरा game कब improve होगा?
Try the all-new Domino's. Order now.
The stage is set for another Congress-BJP face-off before the big finale in 2019. As political leaders face the litmus test, who holds the key to the future of India's Silicon Valley? Tune in as CNBC TV18 travels across the length and breadth of Karnataka to decode the economic and political equations of the Karnataka Assembly elections. Election Exchange, Battle for Karnataka. Throughout this month, on CNBC TV18 and CNBCTV18.com.
Gabon is on the fast track to becoming the most favorable investment destination in Africa. The NCOC Special Economic Zone has opened its doors to international investors, providing major tax benefits like 0% tax on dividends, 0% tax on income for the first 10 years, 100% exemptions on corporate and capital gains tax, 100% foreign ownership and more. Come, invest in the manufacturing sector in Gabon.
Every number has a story to tell, but there's more to them than meets the eye. Find out what the numbers don't tell you, the value they actually give you.
Lower impact on fuel and power.
As we map India Inc.'s financial journey every quarter, boardroom. Throughout this month, only on CNBC TV18.
Welcome back. You're watching Money, Money, Money. And as the new financial year gets underway, we are here to make sure that you get your taxes in order, because we hear this every year. Start early, don't wait for the end. So which are the major taxation changes this time around for 2019? That is what we're discussing now with Mayur Shah of EY. Mayur, so we remember, going back to the finance minister's speech, the one big announcement was return of standard deduction. Then there was LTCG, but I'm not starting with LTCG. We'll get to that contentious issue in a bit. But other tax changes, the slabs themselves, if you could just refresh our memory.
Sure. So, as far as tax rates are concerned, there are no changes in the tax rate, except surcharge, which was earlier 3%, which has been replaced with 4%. As a result of which, the income which is below 50 lakh, the maximum tax rate applies to them is 31.2%, including surcharge in relation to that. If income is above 50 lakhs but below 1 crore, in that situation, maximum rate is 34.32%. Whereas the person who is drawing above 1 crore, the tax rate goes up to 35.88. So you can see that how the rate is progressing when the income is becoming higher and higher. So, apart from that, what has happened that, for salaried employee, the introduction of standard deductions up to 40,000 is being introduced. But as a result of which, they have to compromise on something.
Yeah.
And what has been compromised is the transport allowance.
And I think the medical
reimbursement up to 15,000. So, in effect, the saving, if I look at both, after considering transport and medical, the benefit is around 2,081 rupees. I'm not sure whether it will really help a person, but at least for low-end, income person, I mean, whatever saving is a saving.
At least you don't have to file bills every month. I mean, from a salaried person point of view, you straight away claim the deduction, right?
Absolutely, without any hesitations, yes.
So those are some of the basic changes. I remember there were a lot of announcements with respect to senior citizens in the budget, making life easier for them. I think the interest, the exemption on interest that they get, the deduction on bank interest.
Correct.
Those limits have been revised upwards as well?
Yes. So you are absolutely right. So normally everyone gets deduction up to 10,000 rupees in respect of interest from banks or post office deposits, etc. Now for senior citizen, this has been revised to 50,000 as opposed to 10,000, so that there is a material saving for senior citizen.
Okay.
Along with it, what they have done, because the income exemption has been increased to 50,000, TDS on such income earlier was to be deducted if person is having interest income more than 10,000. Now they have replaced it with 50,000 for senior citizens.
Okay.
So corresponding changes are also being made, so they don't have to file return and claim refunds on those categories as well.
Sure.
So this was the one change which we have seen. The other change which has come, that medical premium which is being paid or any expenditure which are incurred, the limit was up till last year was 30,000 rupees, which has been enhanced to 50,000 for senior citizens.
Okay.
So that is one bigger change which has come. Incidentally,
now, let me ask you this: is this going to help or apply even to children? For instance, as an individual, if I was buying health insurance for my senior citizen parents, then under that section 80D, I could claim deduction.
Exactly the point.
Do I get the higher limit? Do I enjoy that benefit?
You will also enjoy the higher limit if you pay premium for your parents.
Okay, so up to 50,000.
Up to 50,000. Okay. So this benefit is not just extended to the employee or the
person buying the policy.
Correct.
Okay.
So that was the point which I just wanted to mention it.
Anything else that we might be sort of missing out, or any other taxation issues that kick in this financial year?
Yeah, so there are a couple of positive changes also which are being there. So if you recollect, NPS was introduced, and self-employed as well as employees are covered in that. Now exemption for premature withdrawal up to 40%, which was permitted to be exempt from tax, but that was restricted only to the employee. So self-employed persons were not covered. Now they have said that anyone who is withdrawing from that up to 40% will be exempt from taxation. Okay. So the benefit has been extended even for them. The other changes is that there are earlier the assessment used to happen on a physical appearance. Now they are saying it will be an e-assessment, means I don't have to go to the tax officer for my scrutiny. I have to just submit the detail online. Once it is being submitted, the assessment will be done.
Okay. Well, on that note, we'll take a quick break, and on the other side, yes, we get down to the most contentious taxation issue of 2019. That's financial year 2019. The long-term capital gains tax. It kicks in now. How do you get ready for it? We'll discuss that on the other side. Welcome back. You're watching Money, 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 and this week we're talking taxes. It's a brand new financial year, so you need to know exactly what taxes kick in. And LTCG tax, the long-term capital gains tax, is a reality, so we might as well understand it and refresh our memory. So Mayur, let's just go back now. Yes, there is grandfathering, which takes away some of the pain. But just again jog our memory for us that what happens that if I have bought shares before 31st of January, if there is a significant gain, then on what differential do I now pay tax?
Sure. So let me explain this by way of an example, becomes much easier for everyone to understand. So say I had bought shares, say 2 years back at 100 rupees. And as on 31st January, and it's a listed security, so as on 31st January, the market price of that is 150. And I sell it today at say 170 rupees. So what happens, how do I calculate my capital gain and tax thereon so that much needs to be paid? So up to 150, which is the capital gain which has accrued to a person, will not be subject to tax. So therefore 170 minus 150, that is on 20 rupees additional gain, where person has to pay tax at the rate of 10%. Right? So this is one way of looking at it. The other way is that if the price goes down from 100 instead of 150, if it becomes 130 instead of 170, in that situation, there is going to be a loss from 31st Jan 2018 till the date of sale. But such loss will have to be ignored in that situation, and that will not be allowed to be carried forward.
Okay, so that's pretty simple. If we take the same example and change things around, let's say you bought the shares originally at 100 rupees, the price actually fell on the 31st of January, which is the grandfathering cutoff. Let's say it became 80 rupees or 90 rupees. And now you are selling in the market. It might be at a higher price, lower price. then what becomes my base to calculate the capital gains?
Yeah, in that situation, cost becomes the at price which a person has paid to acquire the shares.
Okay.
In the current example, 100 rupees which has been paid will be considered for calculating capital gains.
And not the January 31st?
Not the January, which is lower than the cost which a person has incurred.
Okay, so basically in this case, you know, it's going to be the higher of the two, the original cost at which you bought the shares or the January 31st price.
Absolutely right. Absolutely right.
Okay. Now I just want to understand what happens in cases where you have old shares that maybe, you know, you inherited, or shares that you got during an old IPO when the STT, Securities Transaction Tax regime, was not in place. What is the taxation there?
Yeah. So, you know, there are two situations which you described. So, let me deal with one at a time. So, if you are looking at the shares which were acquired, which was unlisted as on 31st Jan 2018, which was acquired much earlier, it is a long-term assets. Now, any gain arising therefrom, how do I calculate capital gains which are exempt from taxation and the balance which is subject matter of taxation? So, the law provides that those shares which are acquired prior to 31st Jan, which is unlisted and it has been remain unlisted on 31st Jan, whatever cost I have incurred, I will index as if it was acquired and on 31st Jan I am selling. So, that will give me a cost which needs to be considered for capital gain. So, that cost with sales price, I will find out the difference and that will be considered as a capital gain or a loss, and accordingly I have to treat it.
Okay.
Now, assuming that, you know, I have not paid any STT on this at the time of buy, but also not at the time of sale when I'm selling these shares under an IPO situation. Now, this situation is clearly a gray area because law does not cover these kind of issues or aspect or situations, and the one has to decide based on you know, what was the interpretation in past of this situation.
No, so you're talking from the point of view of big investors who are exiting an IPO. If I talk from the point of view of a simple retail investor who has been holding shares from an old IPO for many, many years, in the pre-STT regime, when there was no question of STT.
Correct.
And after 10, 15 years, when you're selling those big, you know, those old shares in the open market, then it's the same indexation.
Same indexation will apply and it will carry on.
Okay.
Now, the issue with arises is in case of not big investors, but also employees who has acquired, like when a startup company comes, so they get a stock option, they acquire shares, and they all exit at the time of IPO. Now, even for them, the tax will be applying because it's a gray area.
Okay.
So that's where, you know, it is impacting employee investors as well.
Clearly, LTCG is not a simple issue at all, and I think we'll only learn as we go along. Mayur, final thoughts, any tips, any advice that you'd like to leave our viewers with respect to taxation in FY19?
Yeah, my suggestion is that, you know, please maintain appropriate documentations, because if these shares are sold after a couple of years and we have to apply these grandfathering provisions, we may not have enough details even to give that exemption at that point in time. So if 20 years down the line when a person is selling, how they are going to prove that this was what was exempt from taxation? So probably all documentation needs to be obtained as on that date.
Okay, fair enough. So make sure you have your paperwork in order. Thank you, Mayur, very much for joining in and demystifying a lot of these important taxation issues for us. Well, there you have it. That's Tax Talk on Money, Money, Money this week. Your feedback, comments, queries, welcome as always. We'll see you again next week.